All right, there we go. 5 p.m. on August 8th. It's crazy that we are already in August and Labor Day is right around the corner. I want to thank everyone for being on this call, whether you are on the call because you are working with me or someone here at Cross Country Mortgage. We really appreciate you being on this call. And this is our home buying education class, so to speak. It's something that we offer to our consumers so that they can understand a little bit more about the market and what's going on. So you're in the right place to get ready to buy. And honestly, getting ready to buy, there's really never a right time, but the right time is early as possible in your process. So when you are thinking about buying a home, that's when you need to get ready, because when you're not prepared, that is when you lose a home. So I offer this class to people that we talk to. I offer it to realtors. I offer it to their clients. And the purpose of it, again, is to educate you. But if you are on this class and you're on this call, you will get a $250 credit towards your closing costs from myself here at Cross Country Mortgage. If you have any friends or family members who want to jump on the call, please recommend them to this call. We host it the second Tuesday of every single month. Okay, so I'm going to kick this off and get started and go through my deck here. I want to have fun with you guys. I want you guys to ask questions. Please post them in the chat. I will monitor the chat. I will answer the questions as we go or at the end, but please start popping them in as soon as you have something hit your mind as a question. I want to give you a quick statistic, and the quick statistic is this. The National Association of Realtors says that only 35% of the people that go through the process are happy with the process. 65% are not happy with the process. Our goal, along with your realtor, is to get you to be in that 35% of the people that are happy. We don't want you to be in the 65%. The way that you're happy is by A, being prepared and being on this call, B, working with a great team like ours who communicates with you at a high level and gets you ready to be in the success zone of buying. Right now, it's a very, very tough time to buy. Forget the fact that rates might be 6.5% or 7%. It's more of a tough time to buy because of the amount of home buyers that are in the market. There are a huge amount of home buyers in the market. And there are statistics out there that say we are anywhere from 3 to 5 or 6 million housing units short. So for demand, we are about 3 to 5, 6 million housing units short. So to meet the current demand, there would be, right now, if 5 million homes hit the market, new homes listed, we would be there. We're not there. Okay. So, that's a little bit of what's going on with the challenge in the market these days. We're going to talk about renting versus owning. We're going to talk about some of the bonuses of buying. We're going to talk about how you assess and plan. We're going to talk about some of the mentally and emotionally challenging things that might come up. We're going to talk about financials, the roadmap, and again, Q&A. I want you guys always to make sure you're asking questions, okay? So renting versus buying. So renting versus buying. Okay, the bonuses of buying are tax benefits, building equity and wealth, the pride of homeownership, family and stability, and it's yours. You can do whatever you want with it. Let's start with the tax benefits. So when you buy a house, you will get a tax deductible tax, you'll be able to deduct your interest on your home against your current income. You will be able to deduct the property taxes you pay on the home against your current income. If you are currently a renter, you're not getting anything but the standardized deduction that everyone gets. If you live with family, same thing. You're only getting the standardized deduction that every person that pays taxes gets. So when you buy a home, you pick up additional tax benefits. You build equity and wealth. Well, it's pretty simple. You guys probably all know this. When you pay a mortgage, you're paying principal every month. So you're paying your equity, you're paying your equity, you're paying your equity. It's basically like forced savings. So if you have a $2,000 mortgage payment, excluding taxes and insurance, and let's just say $1,500 of it is interest, the other $500 is principal, you're paying that down every single month. So it's like a forced savings plan. You also build wealth by home values increasing. We've seen inordinate increases over the last 2 years, and the projection for, let's just call it Fairfield County, and I can get you projections for other counties, but the projection for Fairfield County over the next 1 year is 3.93%. So let's call it 4%. I will tell you, I think that number is going to end up being low, and I'll tell you why in a little bit. But you build equity and you build wealth. Next thing, the pride of home ownership. When you can walk into a house that you know is yours, that you're paying for every month, you have a bit more pride about that home and the asset that you own and the equity that you're building and the wealth you're gaining. It also provides for, a place for family to come. It also provides for stability. So it's a great thing for you feeling good about owning and knowing you're in your own house. And then the fun part of, as you can see, this woman here is painting chalk on a chalk wall. So she painted that wall with chalk paint, and she can, draw beautiful flowers on the wall. You can do what you want. It's your house, your rules. Okay. Now, assessing and planning is super important, and that's something that we're here to talk about. The earlier you can sit down with folks like us, the better you can be prepared. Now, you might be saying to yourself, what is Jay talking about when he talks about the mental and emotional versus the financial side? Well, the financial side is getting you pre-approved and getting you comfortable with a payment that is going to pertain to the house you're buying. Are you comfortable paying $3,500 a month? Are you comfortable paying $2,000 a month? That's the financial side. Can you come up with the $20,000 of down payment and closing costs? Or do you need, first-time homebuyer grant assistance from the Connecticut Housing Finance Authority? That's a program we have. There are income limits on it. Not everybody fits in it. But the point being is you want to make sure you are financially prepared. That's where we come in. On the emotional side of things, that's where you get really excited about a house. But if you're not financially prepared and you get really excited about a house, it could all come crumbling down on you. And I'll give you a quick example. We have a client that came to us last Friday that wanted to put an offer in on a home. They were super excited. They wanted to get pre-approved and they wanted us to do it right away. So we started down the path and started down the process. And we found out today, after doing our homework, they aren't going to be eligible to buy a home. They have to be renters. And there were a few variables as to why. So what bums me out about those clients is they went to a home on Friday. It was their dream home. It checked all their buckets, but they couldn't be pre-approved. And no one can pre-approve them. If we can't pre-approve you, no one can pre-approve you. And I won't get into the details on that situation, but long story short, you've got to be financially prepared so you don't get deflated when you find out you can't buy the home you love. Okay. So it's very smart to be on this call and it's very smart to be getting ready with us. Okay. Next, you want to think about what is the why behind what you're doing. People buy homes because they're renting and their rent is going up. People buy homes because their family is growing or they want to build equity, or they're being relocated. Now, as we know during the pandemic, one of the things that sparked the crazy housing market is pretty much, and almost anyone could work anywhere with a remote capability to work. So, some people move for work. We have a lot of people that, we have one woman that moved from California to Connecticut, is working for the company in California because their company said, you know what, you can work wherever you want. So we see a lot of that. The next thing you want to think about is how long do you plan on staying in the home that you are considering buying? And why is it that we want to think about that? Well, we want to think about your exit strategy. We want to think about the best plan for you financially. We want to think about all the things that could come up. If you buy your house today and you're going to sell in a year, well, think about this, guys. If you buy today and you have to pay a realtor to sell your home in a year, you're going to pay a 5% fee to sell the home. Are you going to gain the equity back by paying down the mortgage and by an increase in home value? So there's a lot of variables that go into play, and we'll work through those numbers with you. Are you purchasing with a partner or someone you're confident in sharing this commitment with? Now, if you're married, you're typically buying with that person. If you're not married, but you're in a domestic relationship, you may consider buying with that person. But you want to make sure you have yourself set up so that if the relationship doesn't happen to work out and you're not married, you have an exit strategy. And that's something you would talk to your attorney about. And then the last bullet point that we've listed here is how much work are you looking to put into your home? Should we consider you putting down less money? So let's say you needed $10,000 to do the floors. Does it make sense to put down 40,000 versus 50,000 to hold the 10 grand back to put it towards the floors? Does it make sense for you to do a home equity line of credit on the house after you buy it, assuming you've put enough money down to obtain a home equity? And we can get into that on your specific situation when we talk to you. Does it make sense to do a renovation loan? So these are all factors that could help you and something you may want to consider and think about, and that's what we're here for. Want to talk a little bit about how a lender thinks and the things that they look at, things that underwriting and the things that we, before we get to underwriting, look at. The number one thing that we look at is your credit. Your credit and your credit scores are very, very, very important. And your credit score could impact the interest rate on the loan you get. The credit could also impact the type of loan you get. So we had a consumer who came to us this week, very low credit score. And this consumer is only eligible for an FHA loan. Now, is there anything wrong with an FHA loan? Absolutely not. There's nothing wrong with an FHA loan, but credit determines these things, and that is the number one thing. So you want to think about your credit. You want to know what your credit looks like, and you want to make sure it's as clean and crisp as possible. Now, if you want to write this down, please write it down. Annualcreditreport.com. Annualcreditreport.com. It is a government-sponsored site where you can go in and pull your credit for a cost of $0. It doesn't give you your scores for the $0, but it gives you all the data on your credit. If you wanted the scores, you could pay $20 and get scores. But the reason why you want to go there and download your credit is because you want to look and see if there's any inaccuracies on your credit report. You want to see if there's any late payments or any financials that were taken out in your name without you knowing. And that might sound crazy, but a friend of mine about, let's see, I've been in the business 21 years. A friend of mine about 20 years ago came to me to get pre-approved. Someone stole his identity, had a mortgage in Texas, took out a car loan, and their credit was totally turned upside down. We connected them with our credit repair person. They helped him repair his credit. He bought about 6 months later, but he had to unwind all that mess. So go to annualcreditreport.com and download your credit report for free. Okay? Monthly survival number. How much does it cost you to be in? How much does it cost you really to live every single month? And we're going to go through a budget on one of the next slides. But you want to understand, okay, I've got $400 a month for groceries. I've got $200 a month for cell phone. I've got cable. You want to make sure that you can substantiate your new mortgage and whatever you spend per month. Cash. Now, not every loan requires a set aside of cash or a reserve of cash after you close, but it's not a bad idea to have 6 to 12 months put aside of your monthly survival number. Now, that can be in the form of retirement or cash. It doesn't really matter. And it's not a necessity for every loan. So I don't want you to think, oh my gosh, I don't have the 6 months, I can't buy. But it's a good idea to start accumulating some of that money or budgeting to accumulate it after you close or while you're closing. Income. Lenders look at income and they want to know your history and do you have stability of earning income? Are you a W-2 salary employee? Are you an hourly employee? Do your hours vary? There's so many things that go into income. Do you have bonus? Do you have commission? All of those things are looked at by underwriting and they would help you qualify for your loan or possibly not qualify if there's not a good history and there's not stability. So that's something that we on the front end and then our underwriters would look at. And what the income ties into, folks, is your debt to income ratio. Your debt to income ratio is a calculation of your housing expense plus your monthly obligations divided by your gross income. So if your gross income is $10,000 a month, that means you're on a salary of 120 grand a year, and your mortgage payment is $3,000, and your other monthly expenses like car loan, insurance, not insurance, excuse me, car loan and credit card, if those equal 1,000, your 3,000 plus 4,000, that's a 40% debt to income ratio. So your monthly expenses that show up on your credit report, that's all we use. We don't use home auto insurance. We just use things that show up on your credit report, like credit cards, student loans, auto loans. Let's just say you have a $4,000 carrying cost between the mortgage and those items that show up on your credit report, and you have a $10,000 income. 4,000 divided by 10,000 is 40%. Your debt to income ratio is 40%, and that would be acceptable. But those are the things, folks, that lenders look at. They really drill down into those items. They want to make sure you're safe and living in that home, and you're not going to get yourself into a tough financial situation. Let's talk about credit scores. This is always a subject that people love to talk about. What makes up a credit score? Well, the scores that we use for mortgage are FICO scores, Fair, Isaac and Company, and it's a 3-digit score, and we get three-digit scores, one from Equifax, one from TransUnion, and one from Experian. Now, FICO has 9 different versions of their report. For as long as I've been in the mortgage business uses FICO version 5. That may change at some point, but again, we are at FICO version 9. FICO scores are very, very, very different than consumer scores. Consumer scores would be like a Credit Karma score, or a consumer score could potentially be a score that you see on your credit card statement. If you have a credit card statement and you have a score on it, look and see if it's a FICO score. FICO is what is used for lending. None of the other scores are used for lending. And what I will tell you is a consumer score always looks higher than a FICO score, always. So I have customers who come to us and say, oh yeah, my credit's 800. We pull the score and it's like 750. There's nothing wrong with 750, but it's not 800 and they're upset. Nothing they did wrong. They're just looking at a different evaluation of their credit. What goes into making up the score? 10% of the score is made up by new credit you take. I would tell you, you don't want to take out new credit often. And if you're planning to buy a home, don't take out any new credit until after you close. If you need to take out new credit, please reach out to us and say, hey, I need to buy a car. Is that going to be okay? Don't do it without reaching out if you're in the process. Or don't do it if you've already been pre-approved, because it could change your pre-approval. The second grouping is 10% is based upon the type of credit you use. Installment loan versus revolving. What's an installment loan? That's like a car loan, okay? It's like a student loan. You have a set amount that you borrowed and you're paying installments every month. A revolving is a credit card, right? And you have a credit card that you buy, pay back, buy, pay back. I'm going to get to another tidbit on revolving soon. 15% of your FICO score is based upon the length of credit history. If you have a really long credit history, you're likely going to have a better FICO score if you've managed that debt well, okay? Now, if you keep opening and closing credit cards, it's not a good thing, okay? If you have a credit card that you've had for 20 years, I would tell you don't close it, because you're going to lose 20 years of credit history that has done wonders for your credit. So if you have any questions on this anytime, please reach out to us. I have an American Express that's been open for 25 years. I will not get rid of it because I will lose 25 years of credit history from that account that's always been paid on time. 30% of your score is made up of how much you owe. And this is very important when it comes to a revolving credit card. If you have a revolving credit card and you have a $10,000 limit, and you are always maxed out, your credit is going to be impacted by that. Make sure you keep your your debt to limit ratio on a revolving card under 50%, preferably under 30% for the most optimal credit score. Now, if you have a credit card limit of $10,000 and you're going on a trip and you're charging $8,000, as long as you pay it down the next month, you're going to be fine. But if you carry that $8,000 or $9,000 balance for months, it will affect your credit score. So keep that in mind. And then last but not least, and the biggest factor is payment history. Are you paying on time? It's very simple. I don't need to go into too much detail on that. Pay your debts on time. My one tip on paying debts on time: if you can go automatic payment on anything you have, set it up. If you have a credit card, you can set that credit card up to draw the minimum amount every single month, no matter what. Now, why is it really important? Here's the biggest reason. People go on vacation, the credit card comes in, they miss it somehow, whatever the case is, and all of a sudden they have a late payment. Set it up on auto payment. You'll never have to worry about that. And you could always finish making the full payment balance if that's what you're going to do when you get the statement. Set everything up on auto payment, folks. It's the best thing you can do. Now, here's a little tidbit. 30% of the people who want to buy a house haven't started early enough in the process because they're worried about their credit being checked. Well, the nice thing about cross-country mortgage is we can pre-approve like 9 out of 10 people with a soft credit pull. So once again, we can pre-approve 9 out of 10 consumers with a soft credit pull, which means we don't need to do a hard credit check, which means there will be no impact on your credit scores. The 1 or 2 clients that we can't help out of every 10 we talk to is if you are using FHA or VA. VA is a veteran's loan. If you're using FHA or VA or a state housing program, we would have to do a hard credit check. But here's the thing about hard credit checks. They're only going to affect your score about 3 to 5 points. It's not terrible at all. And if you get your credit check today with a hard pull, you have 45 days, if you're buying a car or buying a house, to get it checked again without it hurting your credit again. But once again, I'll say it, cross-country mortgages, we pre-approve 90+% of our folks with a soft credit pull. It's a huge differentiator in the market. I'm just going to remind you guys, post questions in the Q&A. I would love to answer any of your questions. Now, let's talk about credit score ranges. You really want to be as high as you can in the 740 and above. The lower you get, the less options you have, okay? That being said, we pre-approved someone today with a 580 credit score. I'm not saying we can't do it, but they're going to pay the price with their rate or their product, that they might have to choose from. So really work on getting that credit up as high as you can. A few tips down here: pay your bills on time, which we talked about. Don't apply too many new credit cards. Do not max out, and keep those older credit lines open, like we talked about with the American Express that I've had for 25 years. All right, next slide. And this is a great one. And this ties into why I want you to go to annualcreditreport.com to pull your credit. 1 in 5 Americans find errors on their credit report. 1 in 5. So 20% of the people out there, 20% of Americans find errors on their credit report. Errors could be wrong addresses, social security wrong, name being spelled wrong, credit that's showing up in their name that shouldn't be. So I would definitely tell you to go look at your credit, go to annualcreditreport.com and pull your credit. Okay. Monthly survival number. So this is AKA a budget. Okay. And what you would want to do is you'd want to fill this out. You want to put in what your rent is, what your auto payment or auto lease is, and go through this and figure out what is your monthly survival number. You want to put in things like groceries, any money that you spend every month. The easiest way to do this, folks, take your ATM bank account statement, take your credit card statement, go through the last 3 months and look at where you're spending your money. And that's pretty much going to dictate where you typically spend your money. Remove anything like a large purchase, like a down payment on a car or a vacation. Remove any of those one-time expenses and just look for your recurring expenses. That'll help you build out your budget and your monthly survival number. Super, super important to do this. It'll make you feel so much better about you and your spending situation. Okay, question that was asked. After paying off a balance in full, do you know how long it would take for the credit report to adjust it? And how far back missed payments do you look? For example, I have 2 and the most recent was in 2016. Okay, so first question. If you were to pay off a credit card today, it would likely update by the 15th of August and filter back through the credit company. So for example, if you have an American Express and you have a $5,000 balance and you pay that balance off today, of course, if you do it through ACH, it's going to pay off much quicker than if you send in a check. But the credit card companies update their balances to the credit bureaus once a month, typically by the 15th of the month. That being said, if you're working with us and you need to buy a home and you need to pay something off to qualify, you can pay it off, prove to us you pay it off, and then we update with that. We update that with the credit bureau within a day to 2 days, so it's almost instantly. As far as missed payments and late payments from the past, we might still see that late payment from 2016, but if you've been paying on time, your credit score that took that drop because of the late payment has worked its way up. And after all these years, 7 years, it's probably in a great spot. So I wouldn't really worry about it. In the moment, a credit blemish hurts enormously. Over time, it starts to wear off. So I hope that answered your question. If you have any other questions on that, please let me know, but thank you so much for that question. I'm going to move on to the next screen. And we're going to talk about a few different products that we have. And I'm going to talk about a product that's not listed here as well. So we have the conventional loans, which allow for as little as 3% down. Government with as little as 0% down. That would be your VA loans for veterans and your USDA loans for rural housing areas. And there is one FHA program that allows 0% down. I would really suggest, with FHA trying to be at 3.5% down. We do also have state housing products like the Connecticut Housing Finance Authority that allows 0% down, but again, there are income limits. Jumbo requires 10% down right now. There are maximum loan limits for some of these, but in all of these categories, conventional, government, and jumbo, 100% of your funds used for down payment and closing costs can come in the way of a gift, okay? They can come in the way of gift. So you can get gift for all of these products for down payment and closing costs, okay? The product that's not listed on here is called our there's two products actually, non-QM product. Non-QM means non-qualified mortgage. It doesn't fit in any of these three buckets. Let's say you're self-employed and we can't qualify you based upon the income claimed on your tax return. We can qualify you with bank statement income. So we look at your bank statements, we look at your deposits, we use a factor, we qualify you on that. Let's say you're buying an investment property and you don't qualify on the investment property with your income, but you will qualify with only the income of the rental property. We can qualify you for that. The other product that's not on here is our renovation and construction loans, which I mentioned earlier. So we have renovation and construction loans. Those go as little as 3.5% down up to about 726,000. So 3.5% down up to $726,000 loan limit. The jumbo loans, which are greater than 726, require more than 3.5% down. All right, next slide. So this is a rent versus own scenario that I did back at the end of 2022. Still pretty applicable today. What I did was I showed someone who was renting for $3,500 how at that time, if they bought for $500,000 with 10% down at a 6.99 rate, which is basically where we are today, give or take, their payment would be $3,865. So their payment only went up $365 a month, and they were able to buy a house at $500,000. Now, when you rent a house and you walk away at the end of the day, you walk away with, at best, your security deposit. On this house, when they walk away with any increase in value and with their principal payment that they pay every month, okay? Also, folks, look at this. You've got, as a renter, they were only getting a $245 tax benefit per month. As a buyer, they were getting almost $600 in additional tax benefit per month. Now, how does that help them? That helps them because it reduces their taxable income by another $600 per month or $7,200 a year, which means they can technically get more in their paycheck because they're reducing the amount of tax that they pay. Okay. The next line item here is the principal payment. When you're renting, you are not paying any principal. When you own, you are paying principal. Okay. Now, one thing that I want to mention here that is really important is a lot of you are probably saying, oh my gosh, interest rates are so high. And they are high relative to where they were in 2020, 2021, and the beginning of 2022. But on a historical average, a high 6 rate isn't that terrible. It's just terrible when the perception is rates should be at 2.5 or 3.5 or 4. Here's the story, or here's the situation. Rates are supposed to be coming down within the next 1 to 2 years. Should you wait for rates to come down, or should you buy now? I will tell you, you should buy now when you find the perfect house and assuming you can afford the payment. And what is the reason for that? When rates go down by 1%, 3 to 5 million additional buyers come into the market or re-enter the market that were priced out when rates went up. So what does that mean? The low level of demand of supply that we have today is only going to get lower, which is going to make it harder, which is going to continue to drive house prices up. Because if you have 10 people bidding on a house today, and in a year from now you have 20 because rates have come down and more people have re-entered the market, it's going to actually work against you. So I would tell you, buy when you find the right home. I'm not telling you to buy now, and I'm not telling you to buy any home. Find the right home, make sure you qualify, and then you refinance when rates come down. And everyone thinks it costs a ton of money to refinance. It doesn't cost a ton of money to refinance. And cross-country mortgage is giving you a credit towards your closing costs when you refinance. So our current program is if you buy now and close before, I think, October 15th, you would get a credit from us of $1,500 as long as you refinance by December of 2025. So folks, if you find that perfect house now, I'm going to tell you, buy it. Don't wait, because there's going to be more pressure on prices and inventory when rates drop. So any questions on that, post them in the chat, but that is a real statistic. When calculating your down payment, you have to remember to include closing costs. Everyone wants a general percentage to use. I don't really like using a general percentage because closing costs vary by multiple factors that we don't know up front. For example, your property taxes. But if you want to use a number, you can go 2 to 5%. I would tell you to go on the high side of that. But what I would really tell you to do is come to us and get a detailed quote. We give everybody a detailed quote, but if you decided, you found a house and the taxes are 10,000, hey Jay, what are the closing costs? We'll help you and we'll walk you through that. Okay. Customer just posted a question and said, I'm planning to buy a home in 6 months. I currently own my home with no mortgage. What products do you advise that I should consider? I would also need to use the sale of my home. Before I could put down the deposit. Should I mortgage, cash out, bridge loan, etc.? I would tell you that, and I don't think we have your application yet, but I think we're getting your application. It's something we would look at. If you own a home now and you have equity, and in this case, you said you have no mortgage, we should look at and consider you taking a home equity line or some home equity product against that house to extract the money for your down payment. And if we extract the money for the down payment from your current home, and you can buy the new home if you qualify, which we'll look at, before you sell your existing home, you'll be in a better spot than having to sell your current home and buy a new home because of how crazy the market is. A bridge loan, and by the way, the home equity line could be looked at a cash out, could be looked at as a cash out. So home equity cash out or can be one and the same. A bridge loan is not a bad product, but it's not used that often. They can be beneficial, but I will tell you, it's a very, very small percentage that fit into a bridge loan scenario. There's not that many that are as good as other ways that we can put this together for you. So when we get your application, we'll go through that with you. If we have your application now and we're working through the numbers, we can definitely discuss that with you. But great question, and we can discuss further with you as we move forward in your process. All right. Let's talk about closing costs. These are just estimates, folks. These numbers can change. When you buy a house, you should get a home inspection. Not everybody gets a home inspection. Even if you get a home inspection for informational purposes, meaning you're telling the seller, hey, I'm getting a home inspection, but I'm not going to nickel and dime you, which in this market is very common. Great. A home inspection is somewhere between 300 on the low side, and that's on the very, very low side, up to $2,000. It depends on the price of the home, which determines the cost, the square footage of the home. That is paid upfront by you to the home inspection company. It's not paid at closing. Your appraisal fee is going to be somewhere as low as $350, could run up to $1,000. The appraisal fee is the only fee that is paid in conjunction with applying for a mortgage before you close. Everything else is paid at closing. So once you have an accepted offer and we order the appraisal company reaches out to you and says, Mr. Smith, your appraisal has been ordered. It's $500, and you pay the appraisal company directly. The next cost that you would typically pay prior to closing or at closing is your homeowner's insurance cost. That is going to be based upon the insurance that you buy. I'm showing you an estimate of $600 to $1,800. We had a policy that came across today at $6,000. It's an intricate situation. Don't worry, folks. Not everyone's insurance is going to be $6,000, but your insurance costs will vary. Lender fees are going to be somewhere between $1,000 and $1,500. That's pretty much any lender you talk to. They're all in the same range. Title insurance, you have to buy title insurance to protect the title to the home. It's a one-time policy, not an annual policy. You would talk to your attorney about it, but it's about $3.85 for every $1,000. So if you were to buy $1 million property, it'd be about $3,800. Okay. If you buy a $500,000 property, it's going to be half. Then you're going to have your attorney fee. You're going to pay an attorney to represent you. It'll be as low as $750, as high as a few thousand. That is determined by your attorney. It's not determined by us. And then you'd have to pay prepaid taxes. So those are the taxes for the property taxes that you have to pay in advance. We will go through that with you in detail when we give you a quote for your home. All right, another question posted. When do you see housing prices coming down? I have to be honest with you and tell you, I don't see that happening for the foreseeable future. We would have to have some sort of major employment fallout, some sort of major event happening. I don't see them falling. If I definitely don't see happening what happened in 2008. That was the combination of a mortgage crisis, really is what pushed that to the brink at that point. Mortgage guidelines were not tight. People were buying homes that they shouldn't be buying. Can we see prices correct at some point? Absolutely. But I wouldn't tell you to wait to buy until prices come down. I don't think that's smart. Because think about this. If you pay $2,500 a month in rent for 12 months, that's $30,000. If you rent for another 3 years, that's $90,000 of money that went completely out the window other than putting a roof over your head. So I would tell you, I would not try to wait for housing prices to come down to buy a home. That would be my recommendation. If my sister were asking me today, should I buy or rent? I would say buy when you find the right house. And assuming you can qualify. Income, I'm not going to go too deep into this. We talked about this before. Do you have consistent earning history? We're going to look at your pay stubs. We're going to look at your tax returns. And if you are changing jobs, please tell us, because if you change jobs during the process anytime, that could kill your deal. Like, your deal could die if you don't talk to us. You might go from a W-2 salary job, making, let's say, $120,000 a year, to a new job making $60,000 base with the potential of making a $100,000 bonus. A $100,000 bonus plus a $60,000 base, in theory, yes, you're making 160 versus 120. But if you don't have any history of earning bonus, we can't use the proposed bonus of 100,000 unless it's guaranteed for 2 years. And I don't know anyone that gives guaranteed bonuses anymore. So please keep that in mind. The next slide here is about the debt to income ratio, which we talked about before. There are two debt to income ratios. There's the housing ratio, and then this says the everything else ratio. The housing ratio, again, is your monthly housing divided by your gross income. And then your total ratio is your monthly housing plus your recurring payments, that cannot exceed 43%. So basically we're saying you cannot spend more than 43% of your income for housing and recurring payments. The other 53% of your income goes to taxes, savings, entertainment, groceries, shopping, etc. So that is how the DTI, or debt to income, is calculated. Keeping your debt to income ratio low obviously helps you afford more. Obviously, affordability is challenged with increased interest rates. We have solutions for that we can talk you through, such as what are called buy downs. But the bottom line is this, folks: don't overspend. Make sure you're creating a budget. Make sure you're living within your means, and set yourself up for success on a purchase of a home. Okay. What makes up a monthly mortgage payment? Pretty simple: principal and interest of the mortgage, the property taxes, and your homeowner's insurance. Those are the four main items. So the principal and interest, the taxes, and the homeowner's insurance. The additional costs that could be applicable are mortgage insurance if you put down less than 10%, or homeowners association dues if you're buying in an association, whether it's a condo or single family association. Okay. Monthly mortgage insurance is mortgage insurance that protects the home, or protects the loan monthly. These two here, the MIP and the MIP is actually an annual policy that you pay one time on the front end of a VA or an FHA loan. So there's multiple types of mortgage insurance. Let's talk about the home buyer roadmap and who you're going to be working with. The main team members on the road to home ownership are us, your lending partner or loan officer team. Your real estate agent is going to be enormously important. The appraiser who appraises the house, we order the appraisal. You don't have to find an appraiser. The attorney that represents you, or the title company. In some states, it's a title company that represents you. In the state of Connecticut, it's an attorney state. So it depends on where you're buying. It's either an attorney state or a title state. Your home inspector, which we talked about earlier, and your home insurance agent. Those are the main players on your team of buying a home. There are others that come into play too, like if you needed a roofing inspection, maybe a roofer, or if you needed a foundation checked out or other things, they might be members of your team, but these are the main players on your team for buying a home. You want to meet with the lender. This says 6 to 12 months. 6 to 12 months is not bad at all. But like I said earlier, as soon as possible, whenever you have the idea of buying a home, that is when you want to start talking with us. Okay. A lot of you are already talking with us. All right, let's talk about this: a pre-qualification versus a pre-approval. A pre-qualification can be done without a credit check, without you giving us any documentation, but it is worth zero, like literally zero. Pre-qualification is meaningless. Are people still doing pre-qualifications? Yes, but a pre-approval is where you give us your documentation and we look through everything. We look at your credit, we look at your income, we look at your assets. I'll give you a live example from a client today. The realtor was working with a client. The client was planning on buying with a low amount of money down. The realtor had a pre-qualification letter, and the realtor said, "Hey, why don't you go get a second opinion from Jay?" Customer came over to us and got a second opinion. And I will tell you guys, this person would not have been able to buy a home. They would not have been able to buy a home. We had to get a little fancy. We had to get a little creative. They had to put more than double down that they were thinking. They were putting a low amount of money down, but they had to put more than double down, which they were fine with. But that pre-qualification, because credit probably wasn't checked, because the income wasn't looked at, it was worth nothing. They were out shopping for a home thinking that they were good as can be, and they really weren't. Were we able to get them pre-approved? We absolutely were. We had to get creative with it. So if you hear anyone say I'm pre-qualified, tell them come talk to us. You won't be pre-qualified by us. For anyone that's on this call that's working with us, this is not a problem for you, but I will tell you a pre-qualification is not what you need. It's not the gold standard in the business, and no one's going to accept an offer with a pre-qualification. A pre-approval is what you need. Okay. We also offer, in addition to the pre-approval, which is called the fast track approval. which is a full loan approval subject to appraisal and your insurance. We can talk to you about that on your individual calls, but pre-approval is the number one thing you need. Next, oh, I have it right here. I didn't realize I put it into my deck. So good pre-qualification, it's really not that good. Better pre-approval, we talked about. The best is getting credit approved. We can credit approve you. We would be happy to do that. It takes a little bit more work than a pre-approval, but it costs you no money. Why would you get pre-approved? To determine your budget, your buying power, to avoid setbacks, and to make sure you're saving time. Like I said, I talked to clients on Friday that were out, that wanted to buy a house, that fell in love. When we finally got their application, they had a huge setback. They couldn't afford to buy. They were all excited, and we had to unfortunately take the wind out of their sails, which we don't like doing, but they have to go be a renter right now. Here are some of the items that we're going to request from you: pay stubs, potentially tax returns, W-2s, bank statements, driver's license, and we're going to check your credit. Okay? You're going to meet with your realtor once you have the pre-approval. You are going to make your offer. We actually will call the listing agent on your behalf to tell them how strong you are and that we have you pre-approved. We will not give them any confidential information, but because we've been in the marketplace for over 20 years, realtors have come to know us and trust us, and they will accept your offer more easily when they know you're working with a trusted source. CrossCountry is a national lender, and so we are known across the country, not just in Fairfield, Connecticut, where my office is. We lend, and my team lends all across the country. Okay, your application obviously helps you get pre-approved, but we will not lock your interest rate until you have an accepted offer and we know your closing date, which obviously we will guide you on that. I want to go over a quick couple of do's and don'ts in the process. Once again, please alert us if your employment is changing or your compensation changing. Please pay your debts on time. If you're moving your money around, please keep a paper trail. Make sure we know of any changes to any debts that you have. If you bought a car, you got to let us know. And if you're going away during the process, just let us know. We have a couple that is away in Italy right now. They let us know. Perfect. We know you're away. We're going to try not to bother you. We can talk over email. And they did a little bit of extra work before going away so that we didn't have to bother them. Don't quit or change your job. Co-sign for any debts. Transitioning from a current employment to self-employment may be problematic. So if you have to do it, talk to us, but don't do it without talking to us. Don't apply for any new credit cards. Don't max out any credit cards like we talked about before. And if you got to move funds from account to account, we're going to require a paper trail. So try not to do that. If you have to do it, we'll deal with it, but let's talk about it. All right. In the home buying roadmap, we're going to underwrite your loan. We're going to underwrite your loan while the appraisal is being done. Once the underwriting happens, we reach out to you with anything that the underwriter might have requested. We're then going to get your appraisal in, and we're going to get you ready to close. Okay. The process can be as quick from application, finding a home. Like you find a home, you've applied with us, you find a home, we can get you fully approved in 2 to 3 weeks and cleared to close and close you in 6 to 8 weeks. We can close you in 3 weeks, 4 weeks. Whatever timeline you need, come talk to us and we'll tell you how we can help you and what timeline we can meet. We just got someone approved and cleared in 12 business days today, okay? So just let us know what you need and we'll work with you. Want to talk about the differences real quick here between a home inspection and a home appraisal, because sometimes people get confused on these. The home inspection is for your purposes. It is for your purposes to know if the home is in good condition. The home appraisal is for your purposes, but also the lender's purposes, and it is more often than not required. A home inspection is not necessarily required. It's whether or not you want to have a home inspection, unless it's a VA loan for a veteran. A home appraisal may not be required if we get an appraisal waiver. We don't get appraisal waivers on every loan. On loans that are non-jumbo loans, that's up to $726,000, we get appraisal waivers about 30% of the time. Okay. The cost of a home inspection could be as low as $500 and as much as $1,500. The cost of an appraisal, like I said earlier, it's going to vary based upon the price of the home. What goes into your closing costs? We talked about this a little bit earlier. Lender fees, title insurance, prepaid taxes and insurance, attorney fees such as recording, and then transfer taxes aren't paid by the buyer in some states. In some states they are. And then points are fees that you pay to the lender to reduce the interest rate. They may apply to your situation. Sometimes people have a bad connotation of what points are, and they think they're terrible. They're not always terrible, but know what you're spending and what you're getting. So we have a client this week that we quoted 6.75, and they said, oh, we saw so-and-so at 5.75. And I said, there is no way they're doing a rate for you at 5.75 unless they're charging points. Sure enough, they went to that lender, they got their quote, and there was additional cost, which are the points, for the lower interest rate. Paying points may or may not make sense, but it is applicable to your situation. It's a discussion we have to have. You should not pay points just to get a lower rate without knowing if it makes sense, and we would explain that to you. Okay, so that is all I have for my presentation. I really try to keep it to 1 hour so that we're done by 6 o'clock here. Are there any other questions that anyone on this presentation has? We had a great turnout for a summer class. I really appreciate it. Any questions here before I end the class? I would love for you guys to post them. I really appreciate you being on this call today. I hope it was super, super helpful for you. I hope you learned a lot. If you have questions about your situation or you have a question you don't want to ask here in the class, please just reach out to us. We're always willing to help you. Between myself and my teammates, we have over 100 years experience. We've been doing this for a long time. This is all we do every single day, is help people buy homes. And we help hundreds every year. So any questions, please reach out. I'm going to end the call because there's been no further Q&A. Thank you so much for being here today. I really, really appreciate it. We will follow up with you with a certificate after this call that you were on the call, so you get your $250 credit. Thanks, folks, and have a great night and a great rest of your summer. Bye-bye.